Hi, welcome to part 2 of our 3-part structured notes series. Today we're going to talk about growth notes. Growth notes are a replacement for your stock portfolio or part of your stock portfolio. This is a great tool to be able to get equity exposure or stock market exposure, but with some downside protection. If you watched part 1 of our video series, we described what a structured note is, how they're issued, and that they're issued by major banks as senior unsecured debt. We highly encourage you to watch that video before watching the actual videos on the growth notes and the callable yield notes. So we're going to jump right in, assuming that you've watched that and understand a lot of the terms that we are discussing. So on the day that we create a note, we're going to go out and we're going to go to bid. And we're going to ask all these major banks if they are interested in participating, and we're going to give them the terms that we are looking for. With growth notes, the maximum we've ever done is 6 years. We're going to pick our benchmarks, and in this example, we're going to use the worst of the S&P 500 and the Dow Jones Industrial Average. Those are two indexes that over time are very highly correlated to each other. With growth notes, we prefer to use a downside protection called a buffer, and a buffer is more of a hard protection. We can do anything between 0% and 100% downside protection, which is called a principal protected note. But through our years of experience, we have found that a 20% buffer tends to work the best and give the maximum return for the risk level that we are taking. So we're going to draw a line here at 20% downside protection, and that's going to be our downside buffer. We're going to have the different banks bid on what they're going to give us on the upside if the market is higher than where it is today when the note matures in 6 years. The current number that we have seen recently is 150%. That means that these notes could have 3 different outcomes. And those outcomes are going to be defined on the day that we create the note. Those terms are going to be put into a contract, and you are going to get a copy of that contract, and we will put that contract in a document file on a secure website so that you have access to it at all times. So there are 3 major outcomes that could happen 6 years from now. Outcome number 1 is the worst of those 2 indexes is going to be between 0% and -20. In that case, you are going to receive 100% of your original investment back. Under scenario 2, the market is down more than 20%. Let's say it's down 25%. In this case, you're fully protected for the first 20%, and you are only going to be down 5%, or you'd get 95% of your money back. In which case, it's not that bad of a situation because now you've got 95% of your original investment to reinvest in a new note when the market is down 25%. And you will be able to leverage that rebound and get your original money back much quicker because you've got 95% of your money at work versus 75% of your money at work if you were just in a long index fund. The third scenario is the market is up. And most likely in most situations over time, during a 6-year period, the market will be up. So whatever the market return happens to be, you would then multiply that by that upside participation, in this case 150%. So we're going to multiply that by 1.5. So just some examples. If the market is up 10%, you'd multiply that by 1.5 and you would be up 15%. If the market is up 50%, you would multiply that by 1.5 and you'd be up 75%. If the market's up 100%, you'd multiply that by 1.5 and you'd be up 150%, and on and on and on, because all of our notes are uncapped. What you see with some of the calendar issues that we talked about in the first video is that you might see somebody offering you 150% upside, but they're going to cap your returns at 18% or 20%, which means anything over that amount during that 6-year period, you will not get. So what are the risks in this? Well, the first major risk is that these indexes do not pay dividends. So if you were buying an S&P index fund, you might get a 1.7, 1.8% dividend yield every year for 6 years. With these, it's strictly the price movement. The other major risk with all these notes is creditor risk. And so all of the terms of these notes are contingent guaranteed. So what does contingent guaranteed mean? Contingent guaranteed means that the terms are guaranteed as long as the issuer, i.e. the bank, does not file bankruptcy. The bank could fail, but as long as it doesn't file bankruptcy, you are guaranteed your terms. And we think that the likelihood of any of the 14 or 15 biggest banks in the world filing bankruptcy is a very low risk. And so we're very comfortable in doing this. But one of the things we try to do when creating a portfolio for our clients would be to create a ladder with multiple investments in which we can have multiple creditors. So we could have notes issued by different banks with different maturities, with different indexes, and create a ladder that we can reduce a lot of those risks. For more information on how the growth notes might work for you, and to answer any of your questions, please reach out to us at any time at Paragaon Capital Management. We'd love to sit down with you, do a video chat or a phone call, answer all your questions, and discuss how this might be an appropriate investment for your portfolio. Once again, I'm Novorr with Paragaon Capital Management, and we look forward to hearing from you.